Welcome back to Boss Economics World. Let's talk about the US Federal Reserve and the problems it's trying to fix by breaking the economy. Yet again. Hello, everyone. I'm Boss, your trusty guide to decoding the wild ride of global finance, with a healthy dose of satire and sharp economics analysis. Today, we're focusing on the latest comments from Susan Collins, president of the Federal Reserve Bank of Boston. The buzzword here is interest rates. You see, Collins thinks more interest rate cuts are needed to steer the US economy into safe territory. But don't let their calm and polished tone fool you. What's happening here is just another chapter in the Federal Reserve's ongoing experimental drama that uses your wallets as the testing ground. According to the Fed, inflation is on a trajectory back to 2%, the economy is in a good place, and policymakers need to move carefully. Sounds reassuring on the surface, right? Well, let's dig into this nice little economic speech and figure out what's really happening behind the suits, statistics, and soft rhetoric. Spoiler alert, it's a financial house of cards, and it's tilting over thanks to years of reckless policy decisions. Here's the Fed's problem in simple terms. 6 months ago, they were obsessed with raising rates as fast as possible in a panic to fight inflation. Now, inflation seems to be moderating, and the economy itself is starting to feel the weight of high borrowing costs, layoffs, slowing growth, and a tightening labor market. So what's their genius solution now? You guessed it, slashing interest rates back down, as if that won't unleash another tidal wave of unintended consequences. Collins's comments highlight the Fed's dilemma. On one hand, they don't want to cut too fast because, let's face it, they don't want to look like they're admitting their aggressive rate hikes earlier this year were kind of a mistake. On the other, they're scared stiff that if they move too slowly, the economy might tip into a full-blown recession before 2024's election year pageantry kicks in. It's a tug-of-war between their ego, the economy, and politics. But we need to think bigger than just quarterly rate adjustments. What Collins isn't saying, and what we'll examine today, is that these flip-flopping policies are creating long-term damage that's much harder to fix. Debt dependency, distorted asset bubbles, labor market fragility, and growing inequality, all symptoms of decades of bad medicine from the Fed. Let's break this down into smaller chunks for clarity. What are the key points Collins is driving home in her remarks? 1. Interest rates are somewhat restrictive. Collins suggests that policy currently remains at least somewhat restrictive. Translation. Interest rates are higher than what businesses and households can comfortably handle, which is why interest-sensitive sectors like housing and manufacturing are cooling off quickly. However, she believes they need to start dialing down rates carefully to ease the pressure without triggering inflation again. But here's the catch, they're stuck. Lowering rates too late risks a recession. Lowering them too soon risks reigniting inflation. What they really fear but won't admit. They've lost control one way or the other. 2. Economy's in a good place overall. Collins says things look fine for now, wages are growing, unemployment remains low, and inflation is easing. This is classic central banker lingo to calm the markets, but here's the truth, while headline unemployment numbers look healthy, quality job growth is disappearing, and wages have not kept pace with the skyrocketing cost of living from the 2021-2022 inflationary surge. When she says demand is resilient, she's not mentioning it's fueled by consumer debt that's at historic highs. 3. Inflation on track to 2% target. Sure, inflation is coming down compared to the 9% peak we saw in summer 2022, but it's still over 50% higher than the Fed's target at 3.2% as of October. And let's not forget, getting inflation from 9% to 3% is one thing, grinding it down that last leg to 2% is much harder. Why? Anchored inflation expectations, wage price persistence, and, oh yeah, trillions of cheap money still sloshing around the economy. 4. Labor market is healthy, but slowing. Here's where things start getting dicey. Yes, unemployment is low, but is it sustainable? The Fed knows a job slowdown is coming. Tech layoffs are growing, small businesses are struggling under rate hikes, and household fundamental savings are evaporating, proving that the healthy labor market they boast about is walking a tightrope. For much of Main Street, the labor market doesn't feel so healthy when high-interest credit card bills hit alongside skyrocketing rent. Let's widen the analysis here. The real story isn't what Collins said but what she didn't say. Behind the finely crafted speech lies a market filled with fault lines that have been widening for years. Let's examine some of the elephants in the room. 1. High interest rates and consumer debt crisis. Did you know household debt in the US is now at an all-time high? In Q3 of 2023, Americans racked up a staggering $17.3 trillion in debt, with credit card balances surpassing $1.08 trillion. Collins talks vaguely about resilient demand, but how much of this demand is real income-driven, and how much is just desperation-fueled debt spending? As rates stay high, monthly payments on loans, mortgages, and credit cards will crush consumers, especially as savings erode. 2. The housing market bubble. The housing market has been a ticking time bomb since the pandemic boom, where low rates sent prices sky high. Now, with mortgage rates sitting at 7–8%, refinancing or entering the market is nearly impossible without gargantuan income levels. Collins might cite this as an adjustment, but for millions of Americans, it spells a housing affordability crisis for years to come. 3. Asset bubbles and stock market volatility. Lowering interest rates after a period of aggressive hikes is the perfect recipe for distorted financial markets. We've seen this movie before. The Fed reduces rates, markets rally in a speculative frenzy, assets inflate beyond reason, and then, boom, another market crash follows when the euphoria fades. The 2008 financial crisis didn't come out of nowhere, it was the result of cheap money policies fueling excessive risk. 4. Wealth inequality, the real winner of Fed policy. Fed monetary policy has overwhelmingly favored asset holders, the rich. When the Fed raises rates, asset prices tend to stagnate or deflate, hurting smaller investors. But cutting rates quickly re-inflates these bubbles, benefiting the top 10% of households who own the lion's share of financial assets. Meanwhile, middle and working class Americans stay pinched on stagnant wages, high-cost rents, and spiraling debts. 5. International ripples, the dollar's dilemma. Don't forget the US dollar's global role. Aggressive rate hikes earlier crushed currencies in emerging markets, leading to soaring debt servicing costs abroad. But weaker policies from the Fed going forward could destabilize the dollar's appeal as a reserve currency. Who gains from this uncertainty? Countries like China, which already have ambitions to erode dollar hegemony. Here comes the chilling truth, my friends, the Fed is running out of tools. The inflationary storm that blew up post-COVID was partially created by years of loose monetary policy, and their aggressive rate hikes in 2023 to 2024 have just piled a new problem on top of the old one. Debt-fueled growth is unsustainable, and constant manipulation of rates won't fix it. The real solution? That would involve admitting the limits of monetary policy and tackling structural reforms, tax reform, investment in productivity growth, rebuilding manufacturing capacity, and addressing income inequality. But these things take years, while politicians and central bankers work on 2 to 4 year timelines dictated by election cycles and market reactions. At the end of the day, Susan Collins's remarks are part of a much larger chess game. The Fed wants you to think it's being cautious and deliberate, balancing inflation and employment like a master juggler. But here's the takeaway, this isn't just another act in a play, the economy isn't a performance, it's real life for millions of people, and the weight of their poor policy choices will eventually fall hardest on the middle and working classes, not the policymakers or Wall Street. So, as always, my dear viewers, stay sharp, stay informed, and don't let the soft-spoken reassurances distract you from the storm brewing on the horizon. Until next time, this has been Boss Economics World, where finance meets critical thinking. Now, hit that like button, share this analysis, and comment below, what do you think is the biggest economic risk creeping past the Fed's radar? Let's keep the conversation going.